January 9th, 2026. A day that shattered 4 decades of market logic. Gold refused to fall. Silver collapsed by nearly 2%. The correlation that built trillion-dollar portfolios broke. But this wasn't just another volatile trading session. Between January 9th and January 15th, 2 massive technical forces converged, creating a window where fortunes would either be preserved or silently erased. What happened in those 48 hours? And why most investors never saw it coming? Welcome to Currency Analyzer. If you've spent years building something worth protecting, a business, a portfolio, a financial legacy, then you understand that the most dangerous market signals don't arrive with sirens. They arrive quietly, like what we're examining today. Before we proceed with this analysis, may I ask you to do something? Hit that subscribe button below. You've accumulated decades of financial experience. You've weathered market cycles that would have broken lesser investors. Don't let a missed warning cost you what you've worked a lifetime to build. And tell us, where are you watching from today? New York, London, Singapore, Mumbai, Lahore? Because what unfolded on January 9th affects every market, every currency, every strategic position on the planet. Drop your location in the comments. Let's begin. January 9th, 2026, a Thursday that started like any other in the precious metals markets, but ended with a question that no veteran trader could answer. At 9:30 a.m. Eastern Time, when New York markets opened, gold was trading at $2,680 per ounce, a price level that had become familiar to investors over recent weeks. Silver stood at $78.99, both metals moving in their usual rhythm, breathing together as they had for 40 years. By 4 p.m., when the closing bell rang, everything had changed. Gold had barely moved, settling at $2,687, up just $20 or 8 for the day. A modest gain that suggested stability, strength even. But silver told a completely different story. The white metal had plummeted, falling 130, a 1.67% decline that brought it to $76.89. And that closing price, it didn't capture the full violence of what had occurred during the trading session. In early morning hours, silver had touched $75.52, a price level that sent immediate alerts across commodity trading desks in Chicago, London, and Singapore. Portfolio managers watching their screens saw something they hadn't witnessed in years: gold and silver moving in opposite directions, not by a small margin, but by enough to break every correlation model built over the past 4 decades. For generations, these two metals had moved together. When gold rallied, silver followed, usually with even greater percentage gains. When gold retreated, silver fell harder, amplifying the move in both directions. This relationship wasn't just observation. It was mathematical certainty, encoded in trading algorithms, taught in every commodity course, trusted by institutional investors managing billions. Traders used this correlation as a foundation, hedging positions in one metal with exposure in the other, building strategies that depended on this synchronized movement. Risk management teams calibrated their models based on this reliable pattern. Portfolio construction assumed it would continue. But on Thursday, January 9th, that foundation cracked. Gold held its ground near record highs, refusing to acknowledge selling pressure. Silver collapsed, falling through support levels that analysts had marked as critical. The divergence was immediate, undeniable, and deeply unsettling. In trading rooms across Manhattan, seasoned portfolio managers stared at their screens, trying to understand what fundamental force could split these metals apart. In London, commodity analysts ran historical correlation data going back 40 years, finding nothing comparable to what they were witnessing. In Singapore, algorithmic trading systems began generating conflicting signals, their programming built on patterns that no longer applied. This wasn't normal profit-taking. This wasn't technical repositioning. This was something structural breaking beneath the surface of the market. And structural breaks, they don't repair themselves quickly. Experienced investors understood immediately what this meant. The hedging strategies they'd relied on, potentially compromised. The portfolio allocations they'd carefully constructed, possibly exposed to risks they hadn't modeled. The assumptions underlying their precious metals positions, suddenly questionable. But the divergence itself was only the beginning, because what traders didn't fully realize on Thursday evening was that they were entering a narrow window, a 6-day period from January 9th through January 15th, where 2 massive technical events would converge. Events that occur only once per year. Events that move billions of dollars through commodity markets with mechanical precision. Events that were about to collide with this already fractured market structure. The Bloomberg Commodity Index rebalancing was scheduled to begin, a systematic restructuring that forces passive investment funds to buy and sell regardless of market conditions. And Friday morning, less than 24 hours away, the United States Bureau of Labor Statistics would release the monthly employment report. the single most watched economic indicator for gauging Federal Reserve policy direction. Two catalysts converging within 48 hours, landing on a precious metals market that had just exhibited the most abnormal behavior in 4 decades. The probability of violent price movements had increased exponentially, but the direction, that remained completely unclear. For investors holding significant precious metals exposure, for portfolio managers responsible for capital preservation, for business owners who had allocated portions of their wealth into gold and silver as strategic hedges, the next 48 hours would determine whether their positions would survive or whether they would face losses they hadn't anticipated. And most of them had no idea what was coming. The fracture had appeared, but the real storm was just beginning to form. What most investors never understand about market crashes is that they rarely happen because of a single event. They happen when multiple forces that normally operate independently, suddenly align at the exact wrong moment. January 9th through January 15th, 2026 was that moment. While traders were still trying to comprehend Thursday's gold-silver divergence, the technical mechanism was quietly activating, one that most retail investors had never heard of, yet one that moves more capital than entire national economies. The Bloomberg Commodity Index rebalancing. Every January, this massive index undergoes a systematic restructuring, adjusting the weightings of its component commodities based on the previous year's data. Liquidity patterns, production volumes, market conditions, all fed into algorithms that calculate new allocations. The process sounds bureaucratic, almost boring, the kind of technical detail that most people ignore. But here's what makes it dangerous. Passive investment funds tracking this index hold tens of billions of dollars in assets. When the index rebalances, these funds have no choice. They must adjust their holdings to match the new composition, mechanically, systematically, without discretion. If gold's weighting increases, every fund tracking that index must buy more gold, regardless of current price levels, regardless of technical indicators, regardless of whether the timing makes any strategic sense. If silver's weighting decreases, those same funds must sell, not because they believe silver will fall, not because fundamental analysis suggests weakness, but because the algorithm demands it. This creates a unique vulnerability, a window where sophisticated hedge funds position themselves, waiting to exploit the predictable order flow that rebalancing generates. They know the buying is coming, they know the selling is coming, they position ahead of it, profiting from the mechanical movements of billions in passive capital. And this year, the rebalancing window opened on January 9th, the same day gold and silver fractured. But the convergence didn't stop there, because Friday morning, January 10th, at 8:30 a.m. Eastern Time, another catalyst was scheduled to detonate, the monthly non-farm payrolls report. In normal times, employment data is important. Traders watch it, analysts debate it, markets react to it, but these weren't normal times. The Federal Reserve had spent months maintaining a hawkish stance, resisting market expectations for aggressive interest rate cuts, citing persistent inflation concerns despite softening economic data. Wednesday's preliminary numbers had already raised red flags. U.S. job openings had declined to a 14-month low in November, 7.7 million vacancies, below the expected 7.8 million doors. More concerning than the raw number was the trend it represented. Hiring activity slowing, new job creation weakening, labor demand clearly deteriorating. For precious metals markets, this created a complex analytical puzzle. Traditionally, weaker labor data supports gold prices because it increases expectations for Federal Reserve rate cuts. Lower rates reduce the opportunity cost of holding non-yielding assets like gold, making precious metals more attractive relative to bonds and savings accounts. But the current environment defied tradition. The Federal Reserve had shown no willingness to cut rates aggressively. Chair Powell had repeatedly emphasized that employment data alone wouldn't dictate policy. Inflation concerns were preventing the dovish pivot markets had anticipated. This meant Friday's payrolls number carried unusual significance. A surprisingly weak report could reignite safe haven demand, sending gold surging toward new record highs. But it could also trigger recession fears, hammering silver's industrial demand outlook, widening the divergence even further. Conversely, a stronger than expected jobs report would likely crush remaining rate cut expectations, potentially triggering profit-taking across the entire commodity complex. Gold and silver both falling, the correlation temporarily reasserting itself. So here was the situation facing serious capital allocators. Two major technical events converging within a 48-hour window. The BCOM rebalancing, creating mechanical buying and selling pressure that operates independently of fundamentals. The employment report, potentially shifting Federal Reserve policy expectations in either direction, both landing on a precious metals market already exhibiting abnormal divergent behavior, both occurring while gold and silver traded near historically elevated price levels. The mathematics of risk had fundamentally changed. Historical volatility models, built on decades of stable correlation patterns, were no longer reliable. Portfolio hedges, constructed assuming gold and silver move together, were potentially compromised. Trading algorithms, programmed based on past relationships, were generating conflicting signals. In commodity trading rooms across major financial centers, risk managers were running stress tests, trying to model outcomes for scenarios their systems had never encountered. What happens if the employment report is weak, but the index sells silver aggressively? What happens if gold rallies on safe haven demand while passive funds mechanically reduce positions? What happens if the correlation breaks down completely during a high-volume rebalancing period? The answers were uncertain, and uncertainty, in markets managing billions of dollars, is the most expensive condition that exists. Experienced traders recognized what was forming a perfect storm of technical factors, converging on a market structure that had already fractured. They began reducing exposure, tightening stop losses, preparing for whipsaw action. But most investors, the business owners who held gold as a hedge, the portfolio managers who allocated to precious metals for diversification, the strategic allocators who trusted 4 decades of correlation patterns, they had no idea what the next 48 hours would bring. The convergence was complete. The window was open, and the violence was about to begin. There's a moment in every major market dislocation when the rules that governed investing for generations simply stop working. Not gradually, not with warning, but suddenly, completely, and like a light switch flipping off in a dark room. Thursday, January 9th, 2026 was that moment for precious metals. But what made it truly dangerous was that most investors couldn't see it happening. Because beneath the surface chaos of gold holding steady while silver plummeted, another relationship, one even more fundamental, one more deeply trusted, was quietly disintegrating. The US dollar index had been strengthening, rising 1.23% over the previous 9 trading sessions, a steady, consistent climb that would normally trigger an automatic response in gold markets. Because for 40 years, longer than most traders had been alive, the relationship between the dollar and gold had been ironclad. When the dollar strengthened, gold fell. When the dollar weakened, gold rallied. This wasn't theory. This wasn't speculation. This was observable mathematical reality, encoded in 4 decades of price data, taught in every commodity trading course, built into countless algorithms and risk models. Currency traders and gold investors operated with this correlation as a foundational assumption, the kind of relationship you didn't question. You simply positioned around it. But now, the dollar was rising, and gold wasn't falling. It sat there, stubbornly, near its December 29th record high of 2,990, refusing to acknowledge the dollar's ascent, defying gravity, breaking the law that had governed its behavior for an entire generation. Portfolio managers stared at their screens, running correlation calculations, checking their data feeds, convinced there must be an error somewhere. Because this shouldn't be possible. In Chicago, a senior commodities trader with 30 years of experience turned to his colleague and said something he'd never said before. "I don't understand what I'm looking at." In London, algorithmic trading systems began generating error messages. Their programming couldn't reconcile the conflicting signals. Dollar strength with gold resilience, 2 variables that weren't supposed to coexist. In Singapore, SRIM's risk management teams convened emergency meetings, trying to determine if their hedging strategies were still valid, when the fundamental correlations underlying those hedges had ceased to function. The question everyone was asking: what force could possibly be strong enough to override 4 decades of currency gold dynamics? What was supporting gold, even as the dollar strengthened? The answer was power. Not market power, not trading power, but sovereign power. Central banks, particularly those in emerging markets, had continued their aggressive gold accumulation throughout 2024 and into early 2026. China, Russia, India, Turkey, Poland. These weren't retail investors chasing momentum. These weren't hedge funds making tactical bets. These were sovereign nations making multi-decade strategic decisions about reserve composition, buying gold not because of short-term price trends, but because of long-term concerns about fiat currency stability. And when central banks buy, they don't look at the dollar index, they don't wait for technical pullbacks, they don't check correlation patterns or consult trading algorithms. They accumulate steadily, systematically, creating a bid underneath gold that traditional market dynamics cannot easily overcome. China held over $3 trillion in foreign reserves, yet its official gold holdings represented only a small fraction of that total. Even modest percentage shifts in China's reserve allocation represented billions of dollars of potential gold demand that occurs regardless of price levels. Because the decision is strategic, rather than tactical, and it wasn't just reserve diversification driving this demand. Geopolitical risk had become structural, not cyclical. Eastern Europe, the Russia-Ukraine conflict entering its third year, NATO involvement deepening, the possibility of escalation ever present. The Middle East, regional conflicts destabilizing energy markets. Iran's nuclear ambitions creating persistent uncertainty. Israel's security operations continuing without clear resolution. These weren't temporary headline risks that fade after a news cycle. These were fractures in the global order, the kind of persistent instability that keeps central banks buying gold and sophisticated investors maintaining safe haven positions, regardless of what the dollar does. In such an environment, gold's role as the ultimate safe haven asset, the one form of money that exists outside any government's control, becomes more valuable. Independent of currency movements, investors weren't choosing between gold and dollars anymore. They were holding both, recognizing that different risks require different hedges. But here's where the paradox deepened. While gold defied the dollar's strength, both precious metals had declined from their recent peaks. Gold down 2.34%, silver falling 4.49% over the same 9-day period. On the surface, these declines looked concerning, a potential reversal of the massive rally that had defined 2024. But context changes everything. Gold had appreciated over 27% during 2024. Silver had posted even more impressive gains, returns that would typically take precious metals years to achieve, compressed into 12 months. After such a monumental advance, some profit-taking wasn't just expected, it was inevitable, healthy even, necessary for the rally to maintain sustainability. Traders, who had accumulated positions throughout the multi-month climb, were now booking profits at elevated levels, taking chips off the table, locking in gains that might not be available weeks or months later. This selling pressure had temporarily overwhelmed new buying interest, creating the modest declines observed over recent sessions, but it hadn't broken the underlying bullish market structure. Technical analysts examining longer-term charts noted something important. Both metals remained in well-defined uptrends. The current retracement had tested support levels, but those supports were holding. The declines had been orderly, not panicked, not the kind of breakdown that signals a trend reversal. So investors found themselves navigating a market of contradictions, the dollar rising, but gold holding firm, profit-taking occurring, but support levels maintaining, short-term weakness appearing, but long-term structure remaining bullish. Traditional correlations breaking, but new patterns not yet established. For those managing significant capital, this ambiguity created genuine risk, not the risk of catastrophic loss necessarily, but the risk of being positioned incorrectly. When clarity finally arrived, and the market made its next decisive move, because markets always resolve ambiguity, eventually, usually violently, and often in the direction that catches the most participants off guard, the paradox would break. The question was, when and which way? Every investor, at some point in their career, faces a moment of clarity, a moment when they realize that two assets they thought were identical are actually fundamentally different. January 9th, 2026 was that moment for precious metals, because what the market was revealing, through violent price action and broken correlations, was a truth that would reshape how strategic capital gets allocated for years to come. Gold and silver, despite being grouped together as precious metals for generations, were no longer driven by the same forces. They had diverged, not temporarily, not technically, but structurally. And understanding this divergence, understanding what drives each metal forward from here, would determine whether portfolios survive the volatility ahead or get destroyed by it. Gold's future, its trajectory over the coming months and years, rests primarily on geopolitical developments and monetary policy decisions, factors that have little to do with economic growth, little to do with industrial production, little to do with corporate earnings or consumer spending. The ongoing tensions in Eastern Europe show no signs of resolution. Russia's conflict with Ukraine has entered its third year. NATO involvement has deepened beyond what anyone anticipated in 2022. The possibility of escalation, of the conflict spreading, remains ever present. In the Middle East, regional conflicts continue to destabilize energy markets. Iran's nuclear ambitions create persistent uncertainty. Israel's security concerns fuel ongoing military operations. And the fragile balance that has prevented wider regional war grows more precarious by the month. These aren't temporary headline risks. These aren't stories that dominate news cycles for a week and then disappear. These are structural fractures in the global order, the kind of persistent instability that keeps central banks buying gold and sophisticated investors maintaining safe haven positions, regardless of short-term price movements. Central bank purchasing activity has remained remarkably robust, even as gold trades near record highs, prices that would typically discourage accumulation. emerging market central banks in particular, continue their steady diversification away from dollar-dominated reserves, not because they expect the dollar to collapse tomorrow, but because they recognize a strategic reality. Concentrating reserves in any single currency, especially one controlled by a foreign government, creates unacceptable vulnerability. China's situation illustrates this perfectly. Over $3 trillion in foreign reserves. Yet official gold holdings represent only a small fraction of that total. Even modest percentage shifts in China's reserve allocation represent billions of dollars of potential gold demand. Demand that occurs regardless of price levels, because the decision is strategic, not tactical, this structural bid underneath gold, combined with its role as the ultimate monetary asset, creates a support mechanism that industrial economic data cannot easily penetrate. Gold doesn't care if manufacturing contracts. It doesn't care if corporate earnings decline. It doesn't care if unemployment rises or consumer confidence falls. Gold responds to currency debasement, to geopolitical instability, to the erosion of confidence in fiat monetary systems. As long as those factors remain in play, gold maintains its fundamental support structure. Silver faces an entirely different calculation. Yes, silver benefits from many of the same safe haven dynamics as gold, but its price determination is increasingly dominated by industrial demand. And industrial demand is directly tied to economic growth. The silver market has tightened considerably over the past 2 years. Mine production has been declining, not because miners don't want to produce more, but because silver is typically a byproduct of base metal mining. And when copper and zinc production slows, silver output falls as well. Simultaneously, demand from green energy applications has surged. Solar panel manufacturing requires substantial quantities of silver. Electric vehicle production uses more silver than traditional automobiles. 5G infrastructure deployment consumes silver at rates previous generations of telecommunications. Technology never approached. This supply-demand imbalance has created a structural deficit in the silver market, more silver being consumed annually than is being produced, a situation that theoretically should support higher prices. But there's a critical vulnerability. If economic growth slows significantly, if recession fears intensify, industrial demand collapses quickly. Solar panel installations get delayed. Infrastructure projects are postponed, manufacturing output contracts, and suddenly the supply deficit becomes less relevant, because demand has fallen even faster than supply. Silver's dual nature, as both a precious metal and an industrial commodity, creates higher beta to economic conditions, higher potential returns during expansion, but greater downside of volatility during contraction. This fundamental difference explains Thursday's divergent performance, and likely foreshadows how these metals will behave going forward. The critical catalysts arriving in the next trading sessions would test these divergent fundamental structures directly. Friday's employment report carried enormous weight. A strong payrolls number showing robust job creation and wage growth would likely diminish Federal Reserve rate cut expectations, potentially triggering substantial profit-taking across commodity markets. Gold and silver could both decline. Silver's drop would likely be more severe, as industrial recession fears give way to higher for longer interest rate concerns. Conversely, a weak employment report, showing significant job losses or stalling wage growth, could reignite safe haven demand, propelling gold toward fresh record highs, while silver's response would depend on interpretation, disinflationary, or the precursor to economic contraction that destroys industrial demand. The ongoing commodity index rebalancing added another layer of complexity. If the Bloomberg Commodity Index reduced silver's weighting while maintaining or increasing gold's, the mechanical selling pressure on silver could amplify any weakness from the employment data, creating the kind of cascading decline that triggers stop-loss orders and forces leveraged traders to liquidate positions, regardless of their fundamental views. Neither metal showed signs of having exhausted its long-term momentum. The bullish structures on extended timeframes remained intact, but the immediate risk-reward profiles had diverged substantially. Gold offered lower volatility, more stable support from central bank buying, better insulation from economic slowdown fears, but potentially more limited upside in the near term, given its proximity to record highs. Silver offered higher potential percentage returns, driven by the structural supply deficit and green energy demand, but came with significantly greater downside risk, particularly if recession concerns intensified or if industrial demand disappointed. For investors managing serious capital, the strategic question wasn't whether to own precious metals, it was how to allocate between them, given these divergent paths, and how to size positions appropriately for the volatility ahead. The traders who would navigate the coming days successfully were those who recognized a fundamental truth: gold and silver are no longer moving as a unit. Different fundamental forces are now in control, and the correlation patterns of the past, may no longer be reliable guides for the future. Tomorrow's employment report would arrive, the rebalancing would continue, and the precious metals market would face its most critical test of 2026. Not a test of whether the rally continues, but a test of whether investors understand what they actually own. And why? Because in markets, understanding the why behind price movements is the only thing that separates strategic positioning from blind speculation. The divergence had been revealed. The question now was whether capital allocators would adapt or whether they would cling to outdated assumptions until the market forced them to learn the expensive way.